Welcome to Slice Property Made Possible. This season, we meet with experts and everyday people to discuss their property journeys so you can learn from their mistakes. Head to today's episode notes to get access to our free home buyers software and to get an estimate of what you could borrow today. Today, I'm joined by someone who has taught millions of people how to build wealth the simple way, Jeremy Schneider. Welcome, Jeremy.
Hi, Amy. Thanks for having me.
Thanks for joining us. We're so excited. For those that don't know in the audience, Jeremy's the founder of Personal Finance Club, where he breaks down investing and financial independence. He's also the co-founder of Nectarine, a new flat fee financial advice marketplace, which we'll talk about later today as well. So what others, though, don't necessarily know is that you've also got a bit of an interesting real estate journey, from flipping homes to buying your first condo with cash, to navigating mortgages as a millionaire without without being able to get finance in the traditional sense. So do you want to share a little bit with the audience about your overall investment journey, Jeremy?
Sure. When I came out of college, university, I was a poor person, not like destitute. I wasn't worried about like food security and things like that, but I wasn't in the real estate buying mindset. So I was a renter for a long time. I was growing a software business that I had started in college. And then I sold that business at the age of 34 for just over $5 million, which was great. And I continued renting until I was 38. And so 4 years later, I guess it's not that long, but I decided to buy my first home. And my net worth at the time was 3.8 million bucks or so. And because I sold the company for 5 million, but my share after taxes was like 2 million. So I took that 2 million, invested it. My investments had been largely, almost exclusively index funds. Essentially, I would buy a big share of the stock and bond market and just hold that for long periods of time. So it was growing. And so I said, okay, maybe I can take some out. So I went to buy my first home. I live in San Diego, which is Southern California in the US, which is pretty expensive market. And so I found a 2-bedroom condo I liked. It was $700,000. I had enough money, 3.8 million is more than 700,000 by a wide
Yeah.
margin. So I had enough money just to buy it, but I decided to get a mortgage. I was like, well, rates are really low. Maybe there's some benefit to diversification from not writing this huge check and having, keeping more of my money in the market, leverage, these types of things were
Good
running
debt,
through my
bad
head.
debt. Yeah.
Yeah. So I'm like, okay, it's not reckless. And so I was like, I'll get a mortgage for 50%, put down a 50% down payment, which in California standards is huge. People who have a 20% down payment are
Yeah,
usually,
most people can't get in, can't get themselves to that 10% or that 20%, and meanwhile,
exactly.
you're ready to slap down half the price.
Right, exactly. So I'm like, okay, and I, had a credit card for 20 years, and I don't know how it works in New Zealand, but here we have credit scores where like the banking system basically grades us on how effectively pay our bills and things like that.
Yeah,
Um,
it's similar. Like, we do have credit scores, but there's a real credit card culture in the US. We're actually just flipping Slice, so it's now actually based out of Delaware, our company.
oh, really? Okay, welcome.
Yeah. Thank you. So actually, there's a lot of credit cards and a lot of like credit opportunity in the States, which isn't quite as accessible in sort of Australasia. But yeah, we still have the same sort of principle around credit scores.
Okay, yeah. So I figured, got a big down payment, great credit score, should be great, and then I applied for this mortgage for half the price, $350,000, which again, by Southern California terms, is pretty modest. And then, and this mortgage broker had been hounding me for years. He's like an acquaintance. He's like, "Oh yeah, like I'll get you a loan." And after giving him all my documentation, all the paperwork associated with getting approved for a mortgage, he finally gives me a phone call, leaves me a voice message, and just says, "You are not approved for any mortgage. You don't get any money."
It's crazy, isn't it?
Yeah, and his reasoning was like, the banking system has this very strict rubric they go by, and you don't have the right kind of income. I hadn't
Mm.
had a year with less than $100,000 of income for probably 10 years or something, but that was like business income, you
Yeah,
know,
they don't really like to look at self-employed income in the same way as, just an employment contract, basically.
100%. Yeah. And I think if I had gone got a job at a, software company and had like, a couple of months of pay stubs, I would have been welcomed with open arms. And then I could quit my job. It seems there's all sorts of ways you can poke holes in the logic, but I was very sick of the process at that point. I was like, okay, I've been jumping through your hoops for, weeks to try to do this, and this is the outcome. So I just wrote a check for the whole house. And I was like, all right, I'm not going to do a loan. I'm just going to buy it. And so that's what I did. I did a wire transaction, and I sold some of my shares in the stock market. And then on the day of the close, the house is mine, and I never had a mortgage. It's actually problematic sometimes. There's some certain like proof of address things, like in order to like vote or
Oh, yeah.
insurance, and they
Like you
say
don't
proof.
get, yeah, you don't
Yeah,
get the document sent.
right, exactly. They say prove your mortgage, prove where you live by showing us your mortgage. I was like, I've never had a mortgage. Like the deed is filed with the county, but like beyond that,
I'm
I
too
don't have the same
successful
proof.
for that.
I know it's a very first world problem.
Congratulations, though. That's so awesome, and obviously with your success with your company so early in your 30s as well. So that was obviously a very different experience for you. But in terms of the process, were there any kind of challenges you experienced from a due diligence perspective, looking at the property?
I do remember being, in my late 30s and a lifetime renter, and being very scared about this entire process. I remember I actually bought a book that's like how to buy a home. I just didn't know there's all these words, right? Like
Jargon.
yeah, escrow and inspections and the realtors and the statements and like and all this stuff that was very confusing to me. And I bought a book on how to buy a home. I thought I was going to break that stuff down, and I started reading the book, and it was more like, make sure if you want a kitchen nook, make sure it has a kitchen nook. And I was like, I don't think I need help with that kind of stuff. Like I think I can and
Work out what I want.
but I think I can decide if I like it or not. That's not where
Yeah.
I'm stuck. I'm just more, I'm like, am I wasting massive amounts of money by choosing the wrong, title company or something like that?
Yeah.
Because there are even now, I don't love the real estate transaction process. It feels like there are 15 little companies that have their hands in escrow, and like money just flies out the window, but the numbers are so big, and everyone's so stressed about the transaction that you're not being very frugal about this stuff. But I'm like, it can be like tens of thousands of dollars between like realtors fees and license fees and title fees and escrow fees and yada yada yada. So
Yeah.
that's the stuff that I was very, you know, concerned about getting wrong.
Yeah, just not very transparent, and yeah, I guess you've just got to throw money at it if you don't know what you're doing yourself, which is also a challenge for many. And then that, however, after that successful purchase, that moved into basically a flip and then several flips. Is that right? So you
Yeah,
bought a
the order is actually out of order. My first home purchase for myself was when I was 38, but when I was, I think, 36, 2 years earlier, I bought my buddy, who was much more interested in real estate, wanted to flip homes, and so I guess technically my first real estate purchase was a flip. Um, and it was funny because I had this big pile of money from selling my company. He had a lot of ambition and hustle to want to remodel homes. And so we kind of partnered, and he was out there trying to find a like kind of a remodeled fixer upper home to buy. And meanwhile, I was living in an apartment. My across the street neighbor put a letter actually addressed to my neighbor, like on our doorstep, that said, "Do you want to buy my house? I'm moving." And he had lived there since like the 70s or 80s or something. And it was a nice house, but definitely like very in need of a remodel. And we ended up buying it. And so I actually asked my neighbor, I was like, "Are you going to buy this house? Because if not, we might." And kind of the same thing. I think we paid 400,000 for that one. And I just again wrote since it's a flip, it's much more difficult to get traditional financing. But
finance, yeah.
so I wrote a check for the whole thing. We remodeled it, put a bunch of money in, sold it, and it was it was successful in that we had a profit, but it was a lot of work, and it wasn't like sometimes you watch the TV shows. I don't know. Do you have these in New Zealand where it's very romantic, and they take a sledgehammer to some cabinets, and then they pick out some tile, and all of a sudden they make 300 grand or something.
Yeah.
Um, there's a lot more work and a lot less profitable than the TV shows make it seem. But we still have got out of it unscathed.
Yeah, so that was sort of more your challenges, you'd say, would be around kind of the renovations and actually understanding what the costs would be and what your profit margins would be, would you say?
Yeah, that totally. That was like a very, there's all sorts of moving parts now. It's, the financing, like what are you gonna do for the money? We actually had a big advantage on that. But then finding contractors, what do you do to the house? The contractors are giving you a good deal. How do you buy materials? How quickly can you do it? With flips, if you hold the house for a year, it's
You're
a
losing or
massive,
you're spending money basically, yeah.
right, it's a massive cost, because not only are you paying property tax and utilities and probably loan fees and all that, but it's slowing down the rate at which you can do a flip. So if it takes you 3 months to make 30 grand or makes you a year to make 30 grand, that's a very different prospect overall.
Experience, yeah.
Right. And so, you have to do it like fast, well, and at a low cost. And those are three things that are pretty hard to reconcile in the contracting world
Yeah,
usually.
that's exactly what I was thinking. I was like, those things in theory work well for you, but the contractors are on their own timeline sometimes.
Exactly.
But did you manage to kind of get quicker with that? Like I imagine the first one might have been a bit slower, and then you sort of get a bit of a method to the madness.
We did four ever. I'm far from a flipping guru,
Hmm.
and each one had its own trials. I think the second one we bought, remodeled, found a buyer in escrow, and then these weird um, excuses started popping up. The money didn't come through. His wife was sick. The bank said they sent it, but they didn't send it. And my warning bell started going off as like a finance person. I'm like, wait, banks don't say they sent money if they didn't say it. Like this you can figure this out. And so then I start basically doing some internet sleuthing, and I find out that this person who put the down or sorry went into escrow, who made the offer and signed the offer, who hasn't given us any money yet, was actually like a homeless person in San Diego living in a shelter and had no money.
No.
And I think that I have like lots of sympathy for people who are homeless, and I wish the best for him. But he certainly was not helping our cause by fraudulently making this offer, which he obviously couldn't back up. And I think maybe he just liked the idea of getting
Home
driven around
ownership.
by, yeah, agents and free bottles of water and cookies and getting shown these, beautiful houses and and the idea
Aw.
of home ownership for a homeless person. What could be more
Yeah, what
appealing,
could be
of course.
more appealing? I
Yeah,
mean, that's why we do what we do at Slice is we do want to reduce barriers to home ownership. But I mean, that's obviously, not the way to necessarily go about it by just
right,
putting in false offers everywhere. So that's wild. So lots
right.
of key learnings on the flipping side of things, and a very different deposit experience. Definitely found the due diligence side of things, I guess, a bit tricky, but you made some profits on those flips and managed to work with the contractors okay in the end.
Yeah, I'd say net end of the day, I did about as well as an index fund investment. I was probably making 10% a year or something on my monies
Mm,
for my $400,000 after all of our expenses and sharing with my friend who was doing a lot of the work. I was taking home 40,000, something like that.
yeah.
And it's not terrible. Like, if you can make 10% of your money, like 40,000 bucks for not doing a whole lot. Well, I mean, I guess I was doing a whole lot. That was the problem. But yeah, my takeaway was real estate, can be great, but it's definitely, work and risk in a different capacity than, investing in an index fund.
Yeah, let's dive into that a bit more because I know you've made a lot of your wealth sort of in index funds and obviously with your business. You've also posted some controversial takes online around, throwing money at a home and home ownership. So, yeah, do you want to dive into that a little bit deeper and maybe, yeah, the challenges with some of those costs?
Sure. My primary way of investing is just basically with buying what's called an index fund, which is just a simple basket of essentially all the stocks in the stock market. And then as all those companies grow and profit, the profits and growth come back directly to you. And we hear a lot in the news about stock market crashes and volatility and the market's at a low, high. But a lot of that is kind of exaggerated by media, in my opinion. If you like really zoom out and look at the 10, 20, 30, 40-year timeline, it's bumpy along the way, but it goes up about 10% per year. And so if you just ignore the scary headlines, ignore the short-term volatility, you can get a great return. And 10% per year doesn't sound, I can imagine a 20-something listening to this who has $1,000 in their bank account saying 10%, 10% of my $1,000 would be 1,100. What's the difference? That's the same thing. But
But it's
over
compounding. Yeah.
exactly. Over time, 10% per year will double your money about every 7 years. And so over the course of a 30 or 40-year career, you can double, double, double. That's like 8 times, 16 times, 32 times, and your 1,000 can become 32,000. And if you start doing, 1,000 a month or 500 a month or even $100 a month, that can become millions over the course of a career. And so it's a very like slow and steady and simple way to invest, but I think it's pretty financially sound.
Yeah. And to be fair, it's not totally dissimilar to property in that it's still kind of you're wanting those longer term gains, like nothing except for Bitcoin is is really about turning a quick buck. And obviously anything that is a quick buck comes with the highest degree of risk and
100%.
and that's a totally different thing altogether. But yeah, the other things that you speak about around property versus and index funds, I guess, is some of the costs and I guess there's a warning in that for our audience around making sure you understand the true cost of property ownership as well.
Yeah, that's a great point. I do think that like the TV shows, like I mentioned, make real estate investing seem like this almost overnight path to wealth. But even in real estate, the real wealth is built over the course of decades.
Mm.
When I meet someone who has like $20 million in the bank, they often are someone who bought a duplex when they were in their 20s. They lived in half, they rented out the other half, and it was modest. Maybe they put some work into themselves, and then they used some of the equity they built in it over the next 5 years to buy a second property. And then, 3 years later, they bought a third property. And, just it sounds fast what I'm saying, but that was 8 years that went by of them,
Mm.
being a real estate investor. But it starts to compound, like you said, okay, now I can start buying bigger properties. The property, the rent, the incoming rent is paying down the mortgage, and then it compounds over time. So it's very, very similar. And I always say that the two things I really would invest in are, stocks and bonds and real estate, because they pay you while you own them and they're likely to go up in value. They're not making more earth, they're not making more land, they're not making more
Mm.
New Zealand. I know that, or
Yeah,
Delaware, those
the
small places. And so if you own some of that and you have renters paying you, it's a great way to build wealth over time. That said, to answer your question, I do think there's an important distinction between investment real estate and your primary property. And the
Mm.
huge difference is with an investment real estate, someone's paying you for it. There's, there should be renters in there paying you to cover your expenses, your mortgage, property tax,
And you should be
maintenance.
calculating, what the cash flow return is on that to make sure that you are covering the true cost of owning that.
Exactly. And so I think what happens is there's this saying out there that rent is just throwing money away. And I really disagree with that, because it's a matter of scale. I could say I've since sold that condo I mentioned. I bought a bigger home, got married. We have 2 kids now. And so I bought a bigger home in the suburbs, much more expensive. And I have a mortgage. And, my property tax bill alone is over $2,000 a month. And, that's throwing money away. And we have a mortgage too. The mortgage is $5,500 a month. And then,
Mm.
we've probably spent $60,000 on little stuff like an upgrade to the fireplace, and we put turf in the backyard, and just like stuff like that throughout the house. And, and it's all throwing money away and that we just lose the money. We hope that we're building equity. But if you look at all those expenses, property tax, property insurance, realtor fees, like we discussed, the closing costs, um, maintenance, these are all things that are throwing the money away in the exact same way that rent is. And so, the common critique is like, well, at least you're building equity. That's true. But if you're renting a place for $1,000 a month and investing $2,000 a month, you'd be far better off than buying a property that's $3,000 a month that you're living in, right? Because
If
you're
it's only, if the value is only increasing at, a percentage that's less than obviously what you're spending each
Right.
month. But yeah, I mean, I think the lesson there is obviously a lot of people go into property and they think the true cost is the mortgage repayments. But actually, you do have insurance, you do have maintenance, you do have, property taxes in the States, and rates are crazy in New Zealand at the moment, thousands of dollars a year that people don't even consider when they're buying the property. So I think it's calculating that and then making, you can do your capital. You can forecast what your capital gains might be and what your rental yield might be if you tenant it. We have a great solution on at slicedby.com around that, but it's really that some people aren't doing those calculations and understanding that there's costs outside of the mortgage. Whereas to your point with index funds or investing in shares, like other than obviously paying a tax on any kind of gains that you're making, you don't have the same kind of cash flow challenges.
Totally. Yeah. And I do think there's just this mentality. I don't know about in New Zealand, but in the US, like home ownership is kind of very romanticized, where it's like, oh, it's like all you got to do is get into a home. And people say, oh, I'm paying $2,000 in rent. Might as well put $2,000 in a mortgage. But you can get yourself in a tough situation because my brother, for example, bought a home. I actually hate to air his laundry, but I think this is generic enough. He won't be too upset. He bought a home right before the financial crisis in 2007, 2008, and it kind of bankrupted him because the home went down in value. And so even though he took out a loan, he put down, I'm making up these numbers, but he put down like $30,000 on a $3,000 home, but that $300,000 home became worth 250. And so he lost not only his entire down payment of $30,000 when he was in his 20s, which was a massive amount of money, but he had to bring $20,000 to closing to pay off the remainder of the loan just to like walk away from the home, right?
That's
And
so sad.
right. And so, that's unusual. Property values usually go up, but there's risk with borrowing money and there's expenses, right? The roof goes out, the garage, the driveway, the yard, the plumbing, like that's just additional risk. Again, not a bad idea, but I just think it's important that,
You
home buyers,
understand that.
yeah, look at all the factors at play and kind of, go into it with their eyes wide open, not just, I'm going to like see if I can just barely make the mortgage payment and cross my fingers, because that can set you up for trouble.
Yeah, totally. Agree with that. And I think the good news is now banks are operating a lot differently to they were around the GFC, like obviously collateralized debt and very kind of cheap debt that was being packaged up and resold. But now, I mean, in New Zealand, for example, the banks are always assessing about it 2 to 3% higher than what the current rates are. And I think gather in the US it's tightened an approach. So hopefully people don't, get themselves into that kind of dire situation again, or we don't enable that in the same way. But still it's just knowing the costs, the true costs, and then knowing that you're actually going to be able to afford them over time, because there will be fluctuations. And if you have to sell or you're forced to sell, that's when it becomes, it can become a massive loss, as you say. So but I mean, imagine he's come back from that. That's a good thing about getting on the ladder early. You're learning those lessons quickly. And so going into the index fund side of things as well, I'm really keen to hear more, because you've obviously got this new venture, Nectarine. Do you want to share a little bit more about what you're doing with that, Jeremy?
Yeah. It's mostly so the world of financial advisors is a scary and confusing world. And again, this is a very US centric view of the world. So maybe you can translate for New Zealand if it's different. But here, when you go talk to a financial advisor, they generally make money in one of two ways. Most of them sell financial products like insurance, investments, and then make a commission from what you buy. And so it's this like mind-blowing conflict of interest where you think you're going to a financial advisor to like have them look at your holistic financial plan and see if you should be paying down debt, or what you should do about your student loans, or if you should be investing more, if you should buy or rent, and things like this. But they only make money by selling you stuff, and so they want to sell you insurance or sell you financial products.
Which is sort of a weird way to incentivize, because you're being forced towards a certain product, basically.
100%. Yeah. Weird is putting it extremely nicely. I'd say like corrupt, because it doesn't
Sure.
help the individual, right? The other way most financial advisors make money is by taking all of your assets under their management, investing it for you, and then charging you like a percent of your assets under management, or AUM. And that's better because then at least they're not putting you in a bad product because they make a higher commission, but still is kind of a weird incentive because they're not really incentivized to help you, give you advice on a financial plan. Their incentive is to get all of your money uh, under their custody and then keep it there as long as possible to charge you for it. Of course, they want it to go up because they did make more, but what they really want is just have you not go away. Um, and so I've been teaching, I've been a lifelong personal finance enthusiast. I've been teaching this for the last 7 years. And when people would ask about financial advisors, I would say, that's how most charge, one of those two ways, commission or AUM. What you really want to look for is a flat fee financial advisor, someone who charges by the hour or by the project just for the advice without these weird conflicts of interest. And when I would explain it, there'd always be this light bulb that goes on over the investors' heads and they'd say, yes, that's exactly what I want. How do I find one of those? And my answer would always be, I have no idea. There's very few that do that. It's very hard to find. And so we built it. So we built a company called Nectarine, which I kind of feel like a slice. It's kind of like in
Yeah,
the
I feel like it
fruity,
works.
yeah,
Yeah,
you can have a slice of nectarine.
you can.
Um,
And
uh,
we have a similar model as well in that it's flat fee, but for property services. So yeah, I mean, it's really just about that end buyer, right? Getting the transparent advice that's not kind of dictated based on the particular product that they're
yeah,
purchasing.
I love that. And and it's maybe you find that like the industry pushes back on that because the industry really likes to have those percentages, get those commissions, because it kind of like gets lost in the mix. You're like, okay, my investments went up X dollars, the fee was Y dollars, whatever the net is. But I think it's much better for for individuals to know what they're paying. Have a flat, clearly advertised fee without the weird incentives for them to be pushing for something else.
100%. And when
Yeah,
you're budgeting as well, that's helpful. Whereas if the fees are constantly changing, that can be super challenging. But I think if the demand's there, like in the same way that you obviously, I imagine Nectarine, I mean, I'm keen to hear more about how you moved in that direction, but I imagine that was sort of born out of Personal Finance Club and just having, a bunch of people asking you, well, what is the right advice? Who should I be going to, right?
100%. Yeah, just for years, people would say, "How do I find a good financial advisor?" And it's like the one question I couldn't answer because I really felt strongly about the flawed business model. And so yeah, we built Nectarine, and so now you can go to hellonectarine.com and see everyone's price by the hour or by the project, reviews, expertise. There's like 100% money back guarantee if you're not happy. It's like exactly the
Oh,
opposite
awesome.
of what every other financial advisor out there is really doing. And thank you for letting me plug it.
Yeah, no, absolutely. I mean, I like it. So I don't let people plug things that I don't like. No, I'm kidding. But I genuinely do believe in flat fee models. And I think, yeah, I think there's a real need for this. And I think, there's obviously so much demand. You've built an amazing community and following with Personal Finance Club. There's so much demand for education, but then the layer is moving from that into execution and how we can actually help people get the right advice and, for the right price. So I love that you've taken, and it makes sense. Obviously, you've built ventures before as well, but to actually be able to support your community to execute is a very exciting thing.
Yeah, I agree. And yeah, I always say like education is still the foundation. If you walk into a Nectarine meeting or a meeting with any other, expert and you have no clue, you're going to be at the mercy of just whatever they say. And in the financial services world, that seems to be much more scary for some reason. Like, doctors, I'm like, okay, you kind of trust that doctors are, their incentive is to be on your side. But for some reason in the financial services community, their incentive is to make the most money from you, right? And so education is still critical, but still there's times where you know what you're doing, but maybe you have an inheritance, or yeah, you're facing a real estate decision, or you want an expert set of eyes just to see if they know something that you missed. And it's nice to have somewhere to turn, which isn't going to kind of try to push you down this weird direction, which you don't think is the right way.
Yeah, and I think where, we've talked about index funds, we've talked about property, we've talked about business ownership in today's episode. I think, there can be a lot of different wealth strategies. And so that's where that financial advice can be great. And I think over the next decade, that's going to become more important, is that holistic, based on your circumstances, what does the right portfolio look like for you? And if you're, self-employed, for example, and you need your cash flow, property actually might not be the right thing for you at a point in time, and index funds might be better, or actually you're investing in your business. And so I think, yeah, some people will just beeline for a particular asset class or an investment as well. But if you go to an advisor and you kind of work through your personal circumstances, I think there's a real big opportunity there for people to get a better sense of what's right for them, because it's not necessarily, what's right for you is not necessarily right for me, and vice versa.
Yeah. I do love all three of those asset classes, though. I spend a lot of my time educating on the internet, and there are comments who are like, why do you hate real estate? Or why, you didn't actually make money from index funds. You made money from your business. And, it's like all of these things are true. I grew a
I made
business.
money everywhere.
I know I'm just falling backwards in money everywhere I turn. But yeah, it's not like, it's kind of as the age of outrage where it's like one is wrong and one is right. It's like, no, like I'm fully for entrepreneurship, real estate investing, great. Index funds, great. Or the share market, great. And like you said, depending on your situation, I always say if I like index funds now because I think my time is better spent building digital things, building businesses than it is like flipping homes, for example. But I always say if I was 25 with $10,000 to my name, I think I would totally go try to buy an investment property nearby, put a lot of the work in myself, use some leverage, try to, start that process of building that compound growth into my first and my second and my third. I think that would be a really great way to build wealth. It's not easy. It takes time. It's not a get rich quick
Yeah.
thing, but it's a better way, I think, to turn 10,000 into, 100,000 than just, waiting 20
Totally.
years.
Well, it's that leverage effect, right? You're not investing 10,000, you're borrowing another 500,000, or, whatever from the bank. So you're actually investing 510,000 instead of investing only your 10. So that is the benefit of property. But I think it's just, yeah, it really depends on your circumstances at the time and what you're trying to achieve. But where have you actually made the most wealth then, Jeremy?
I think the scales have recently, obviously when I sold my company for 5 million, my share after taxes was 2 million, and my net worth was like 2.1 million because all of the money I'd made previously like added up to 100,000. Now my net worth is over 6 million, and almost all the rest of that, well, most of the rest of that is index funds and a little bit is real estate. So I think technically the bulk is index funds at this point, but with the
It came
caveat that,
out of probably your business originally.
right, exactly. So
Yeah.
the principal came from the business, and so, and the real estate has done well for me too. The condo I bought for 700,000, I sold for 1.2 million, but I did put 100,000 remodel into it, and paid property tax, and there's all those expenses. So it's really easy to subtract what you paid for it from what you sold it for, but you
Well,
kind
it
of
feels
forgetting.
better.
It feels really good, but
Yeah,
then you're
yeah.
like, oh yeah, I was paying a mortgage in there for 7 years too, wasn't I? That wasn't free.
Yeah, I didn't factor that in my profit share. Um, awesome. Well, I've got the last question for you today, Jeremy, but thank you so much for joining us. Before I let you go, I'm going to ask, if your first home had a doorbell and that doorbell played a theme song, what song would it play?
Oh, I'm bad at music. It would play, this is going to not land at all with your audience. It would play the Michigan fight song because I went to school at the University of Michigan in the US, and I'm like, my brother, my parents, my grandfather all went there. And I was actually have a Michigan tattoo on my leg, like
Oh,
a tattoo of the logo of the University of Michigan. And so
Die
I
Hard.
think that's not only like, is that like the theoretical answer? Now that I'm saying it, I'm probably going to do that. So apologies to my wife if you're listening, but the
You're
Michigan
about
theme
to go.
song is coming to
You're
our.
about to go get a doorbell, and every time you arrive home, and you'll be walking in like lifting your shorts up, showing the tattoo, flirting the
That's
tattoo up.
right. And I'm going to make her
Amazing.
sing along with me. She did not go to
Amazing.
Michigan, so she doesn't get it.
Thanks so much for joining us today, Jeremy. It's awesome to chat.
Thank you so much for having me.
Thank you for joining our community. Please leave a Spotify or Apple review so we can support more people into home ownership. Check out today's episode notes for your free home buyer software and to get an estimate of what you could borrow today. A quick reminder, Slice the Podcast does not provide financial advice as we are not taking your personal circumstances into consideration. However, when you join our software platform, we have a team of financial advisors ready to support you free of charge.